PantheonAI presents Debt Ceiling Chaos, Ethereum Surge, and Maritime Crisis. Good morning, everyone. Welcome back to the PAI Morning Briefing. I'm John, your host from PantheonAI, and it is June 24, 2025. Hope you're ready for an engaging and in-depth discussion about the markets, some major trends, and, honestly, a ton of important news items that are really shaping our global economy.
Absolutely, John, and I'm Sarah. Excited to dive into all of this with you. So much to cover today. Where should we kick things off?
Let's start, as always, with a quick market overview, shall we? On the equity front, the S&P 500 is hovering around 6,085.75, showing a modest increase of about 0.4%. Over at the Dow Jones, we're seeing it near 43,016.878, posting an advance of roughly 0.5%. In the Nasdaq, trading close to 19,901.640625, with gains of about 0.46%.
Okay, so a pretty steady uptick across the board for equities. But what about crypto? I know that's always a different story.
You're right, Sarah. A bit of a mixed bag there. Bitcoin is trading at roughly $105,352.992, which is actually a slight dip of nearly 0.06%. But Ethereum, on the other hand, is on an upward trend, trading at about $2,440.190185, up by a healthy 1.136%.
That's interesting, isn't it? This mixed picture isn't entirely surprising, though, given how investors are trying to balance traditional market optimism with, let's say, a more cautious sentiment in the crypto arena. We're seeing this broad market rally in equities, but then that slight hesitation in crypto, especially with traders weighing volatility against emerging institutional interest. Ethereum's surge, in particular, seems to be grabbing attention.
Exactly. And that brings us to our deeper dive into major market trends. What stands out this morning is that relative steadiness in the traditional stock indices. It really seems driven by continued corporate earnings stability and, like you said, cautious optimism among investors. Many traders are trying to balance domestic economic indicators with global developments.
Yeah, and I've noticed the technology sector, being such a significant component of the Nasdaq, continues to exhibit strength despite recent regulatory headwinds. Industry experts are saying that the sustained momentum in tech, especially in cloud computing and AI, reflects underlying innovation that could really propel future growth. It's almost like they're innovating their way out of some of those pressures.
This is a great point. And in stark contrast to that equity strength is Bitcoin's slight underperformance. It's a reminder that while institutional adoption is catching up, the crypto market remains prone to these sudden movements and shifts in market sentiment. Ethereum's recent outperformance, it just makes you wonder, doesn't it? Are investors looking for alternatives within the digital asset space, especially those offering an expanded range of use cases beyond just a store of value?
Totally. Is this a temporary rotation of interest, or are we witnessing a sign of structural change in investor preferences? That's the million-dollar question. Or perhaps the $2,440 question given Ethereum's price. But on that note, let's take a closer look at some of the stories making headlines today. We've got about 10 in total, but 4 in particular are really providing a richer context to navigate this constant ebb and flow of global markets.
All right, so first up, Maritime insurance. This is a big one. Many insurance underwriters are now stating they won't offer coverage for shipping vessels linked to the U.S., Israel, or the U.K. at any price. Tensions in the Middle East are just driving up war risk premiums to an unprecedented level.
Wow, that's huge. That development is sending ripples through global trade. Shipping companies are facing increased costs or even outright unavailability of insurance. The repeated messages from multiple sources emphasize that the maritime insurance market is experiencing a significant tightening of risk appetite, which could lead to higher freight rates and possible delays in international trade. It's a real-world example of geopolitical risks impacting sectors far removed from the conflict itself.
And then we shift gears to fiscal policy and the debt ceiling. Senate Republicans have come out in support of a debt ceiling increase by $5 trillion, which would be the largest ever proposed. The implications are enormous. While some might quickly suggest this signals unchecked fiscal spending, experts argue that in the short term, borrowing costs are unlikely to rise dramatically due to the current accommodative monetary environment and a robust appetite for U.S. Treasuries.
But John, this legislative move also carries long-term implications, right? How might such a significant borrowing increase impact the nation's credit rating, or even the broader fiscal sustainability debate? It's a scenario that continues to fuel debate among economists and investors, reminding us that fiscal policy choices can have ripple effects that span decades. And speaking of long-term implications, our third set of headlines, consistently echoed by multiple voices, touches on the U.S. economy's vulnerabilities, as predicted by analysts at Bank of America Global. They suggest that if something is going to break in our economy, it will likely be during the summer of 2025.
That's a pretty stark warning. They point to a bifurcated path in monetary policy ahead, one with tightening policy to stem inflation, and another with a more prolonged period of easy money. It's a cautionary note that the decoupling of real economic growth from policy support might be closer than we think. For us, as individual investors and market strategists, the question remains, how do we best position ourselves when the signal-to-noise ratio in economic indicators seems to be declining?
Exactly. It's getting harder to read the tea leaves. And then our fourth story focuses on the housing market. Even as home prices have seen a fall, the peak spring selling season was notably underwhelming. Builder KB Home, a major name in the construction sector, actually cut its outlook for sales, profitability, and even home prices, citing affordability challenges and growing economic uncertainty as key factors behind weak demand. The housing sector has long been a bellwether for consumer confidence, so this is definitely something to watch.
It really makes you wonder if we're in for a prolonged slowdown in real estate or if a rebound is possible as affordability improves. And what's crucial to understand about these four stories we just discussed is that they're not one-off occurrences. They have repeated emphasis, consistent narratives reinforced by multiple independent sources. This repetition truly underlines their criticality. Geopolitical risks affecting maritime insurance, a significant fiscal policy debate on the debt ceiling, the potential fracturing of economic stability as highlighted by Bank of America Global, and the persistent challenges in the housing market.
That's such an important point, John. Each of these stories not only has immediate implications, but also positions us to evaluate longer-term trends that might influence everything from shipping logistics to consumer spending. So let's transition now into a detailed sector analysis, starting with tech.
In the technology sector, where innovation often redefines market paradigms, we're seeing a robust recovery that both investors and corporate strategists are really excited about. Even as tech giants face regulatory pressures, their earnings reports have largely beaten expectations, buoyed by rapid advancements in areas like AI and cloud computing. This sector continues to be a bright spot within the Nasdaq, pushing up the overall index and reaffirming tech's importance in the modern economy.
For tech investors, the big question on many minds is whether further regulatory changes will dampen that innovation, or if the sector's inherent dynamism will actually drive fresh rounds of growth. Then there's the energy sector. Always a fascinating one. Facing both sustained geopolitical uncertainties and a global pivot toward renewable sources, it's in an intriguing phase of transformation. Traditional energy stocks have had to navigate this volatile interplay between supply disruptions in certain regions and long-term trends toward sustainability.
Yeah, with many markets still adjusting to the impacts of geopolitical tensions on oil supply, coupled with significant investments in green energy alternatives, the sector is truly at a crossroads. It makes for a fascinating watch, where the familiar may soon begin to look very different under the pressures of global change. Investors are increasingly considering how to balance exposure between traditional energy projects, which might benefit in the near term from supply constraints, and renewable energy initiatives that promise a more sustainable future.
And finally, in the financial sector, recent news surrounding the debt ceiling increase and broader macroeconomic policies really underscores the significant role that banks and financial institutions will play in the coming months. On one hand, a higher debt ceiling may lead to increased government borrowing, which could be positive in terms of liquidity.
But the accompanying fiscal debates and potential long-term impacts on credit ratings and borrowing costs present risks that financial institutions and investors must closely monitor. Traditionally, the finance sector is super sensitive to shifts in monetary policy. As we navigate this complicated period, market participants will need to be especially mindful of how regulatory shifts may further complicate the current environment, from lending practices to capital allocation.
Absolutely, and it's not just domestic, is it? The interconnectedness of these domestic stories with international economic developments cannot be overstated. Geopolitical events, from Middle Eastern tensions affecting maritime insurance to shifts in fiscal policy debates in Washington, are all weaving themselves into the broader global tapestry. Investors in Europe or Asia are observing these shifts with a mix of concern and opportunity.
Right. For instance, the tightening of insurance coverage for shipping vessels doesn't merely affect U.S. or UK-linked companies. It has ripple effects that touch every corner of global commerce. Similarly, debates in Washington about debt ceilings influence international perceptions of U.S. creditworthiness, potentially impacting everything from emerging market inflows to global interest rates.
It's a truly global domino effect. Now let's move into some expert insights and predictions for the day. One of the recurring themes we're seeing is this delicate balancing act between growth and caution. With robust performances from major indices and corporate earnings well in view, it's hard not to be optimistic. Yet the persistent warnings from economists about potential vulnerabilities, whether in the mortgage-backed securities market, fiscal policy, or even crypto volatility, serve as a prudent reminder that every coin has two sides.
It really makes you wonder, is it possible that we are on the verge of a repricing in risk across multiple sectors? And how might the debt ceiling debate evolve, and what could that mean for investor sentiment if the market begins to question fiscal sustainability? These are the kinds of thought-provoking questions that remind us learning shouldn't feel like a full-time job, but a continuous journey of discovery.
Exactly. And, while discussing all of this, let's not forget to inject a splash of humor. I must confess, John, when I see headlines about a $5 trillion debt ceiling, I can't help but think, $5 trillion? That's like my monthly coffee budget multiplied by a gazillion.
Ha! I hear you, Sarah. My thoughts exactly. But in all seriousness, such fiscal maneuvers are about as complex as some of the most labyrinthine aspects of our financial system. Sometimes I wonder if the policymakers are playing chess while the rest of us are trying to figure out checkers. It's an odd world, but it certainly keeps us on our toes.
It really does. And returning to the markets, many of you might have noticed that the slight uptick in the S&P 500, the Dow Jones, and even the Nasdaq suggests a degree of resilience that is quite reassuring. However, as we noted earlier, the cautious behavior of Bitcoin and the rising tide of Ethereum indicate that digital asset markets continue to traverse a steep learning curve. It's almost as if the crypto space is saying, yes, we're here and we're evolving, but don't expect us to suddenly behave like your reliable blue-chip stocks.
That's a perfect way to put it. This is a reminder that, while diversification remains key, understanding the nuances of each asset class is more critical than ever. And on the fiscal front, that Senate's move to propose a $5 trillion debt ceiling increase has generated fierce debates among policymakers and market participants alike. Some view it as a necessary step to avoid an immediate fiscal crisis, while others are more concerned with its long-term implications on future borrowing and government spending.
I mean, when you're borrowing the equivalent of $5 trillion, how do we ensure that we are not creating a financial house of cards? And if the solution to one problem introduces a Pandora's box of another, how do we as investors and citizens react? These questions are truly at the forefront of discussions in boardrooms and policy meetings alike.
And another recurring theme, as you pointed out, is the situation in the maritime insurance market. It really gives you a perspective on how intricately interwoven global events have become with our everyday economics. Who knew that a shipping vessel's insurance policy could become a bellwether for geopolitical risk? It reminds us that while trade might seem like a routine part of commerce, in times of crisis, even the mundane, such as covering a vessel, can become a headline-grabbing issue.
It's true. I'd be curious to hear our listeners' thoughts on this. Perhaps it's time for a seminar called Insurance Underwriting for the Modern Age. I jest, but seriously, this is a market reality that few had predicted would impact so many aspects of global trade. Now, while we have a lot on our plate today, let's turn our attention briefly to the global landscape. Across the Atlantic and into Asia, policymakers are watching the developments in the United States with keen interest.
Absolutely. The decisions made in Washington, D.C. regarding debt ceilings and fiscal policy have a way of sending waves across international markets. Investors around the world are revisiting their positions, reconsidering exposures, and in many ways waiting to see if a domino effect might occur. European financial markets, for instance, are already factoring in a potential overhang in U.S. policy, while in Asia, seasoned investors are looking for safe havens in emerging markets or blue-chip securities that promise stability amid this uncertainty.
And in energy markets, which are as volatile and challenging as ever, there is a clear sense of transition. Oil prices have been sensitive to every geopolitical whisper coming from the Middle East, and the latest tightening of maritime insurance has only added fuel to the fire. Metaphorically speaking, of course. The energy sector is on this razor's edge. where the old world of fossil fuels is being forced to reckon with a future that is decidedly green.
For energy investors, the challenge is how to balance legacy assets that might benefit from short-term disruptions against a long-term transformation into renewable energy sources. It's a fascinating period of change, and the ripple effects will likely be felt for many years to come. Before we wrap up, let's take a moment to reflect on some expert predictions. Many seasoned market analysts are advising caution. They suggest that investors should keep a close eye on fiscal policies and remain agile in a market that is simultaneously optimistic and cautious.
The consensus seems to be that while the markets are currently showing resilience, underlying issues such as fiscal imbalances and geopolitical uncertainties mean that a bout of volatility might still be on the horizon. One expert even commented that if the markets were a car, we might be cruising along smoothly on the highway, but with clouds on the horizon and a possibility of heavy rain, keep that windshield wiper ready.
That's a great analogy, Sarah. As we draw this morning's discussion to a close, let's recap the key takeaways. The equity markets have shown modest but steady gains across major indices, while the cryptosphere offers its own dynamic narrative with Ethereum leading the charge amid Bitcoin's slight dip.
And on the news front, 5 major themes have emerged. A tightening maritime insurance market due to geopolitical tensions, that significant legislative proposal to raise the debt ceiling by $5 trillion, warnings from Bank of America Global about potential economic vulnerabilities this summer, and the continuing struggles in the housing market, with builder KB Home revising its outlook amid weak demand.
Our sector analysis further underscored the resilience and challenges in technology, energy, and finance, while global market watchers remain alert to the interconnected effects of these domestic developments. So, I'd like to leave you with some thought-provoking questions. Have you reevaluated your portfolio in light of the fiscal debates and global market uncertainties we discussed today?
Are you reconsidering your exposure to sectors sensitive to geopolitical risks, like maritime insurance or energy? And perhaps most importantly, how do you balance optimism from a strong equities performance with the caution warranted by warnings from experts such as those at Bank of America Global? Your answers to these questions not only reflect your individual strategy, but also help shape the broader conversation about our shared economic future.
As we part for today's episode, I want to give a special shout out to PantheonAI, your information Copilot. Our aim is to provide you with clarity and insight in this complex market environment, ensuring that you are armed with the knowledge needed to navigate these dynamic times. Thank you for spending your morning with me and Sarah on this journey through markets and headlines.
We encourage you to come back for the next episode tomorrow, where we will continue to delve even deeper into the stories and trends that matter most. And remember, if you ever need clarity or wish to ask questions, you can always reach out to our AI Copilot for that extra bit of guidance. Learning shouldn't feel like a full-time job. Have a fantastic day, and until next time, keep questioning, keep investing wisely, and stay curious about the way our world is shaping up. PantheonAI, your information Copilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.